So COVID-19 is definitely starting to have an effect on getting a home loan and on purchasing a home. And what does it mean for you? What does that mean for your credit score? We're going to answer those questions, so hang around to find out. Welcome to the Kester Property Team video series, where we help you solve the real estate puzzle and answer your questions. I'm Tom, and I'm the team leader of the Kester Property Team, and I'm glad you're here with us today. So today we're talking about COVID-19 and the effects that it is having on the financial market, and specifically getting a home loan. See, I've had buyers calling me and saying, my lenders are changing their requirements. Well, a couple things to know. First of all, the government, FHA, USDA, VA, those requirements are not changing. What's changing is the individual lenders that buy mortgages on the secondary market. They're raising, some of them are, raising their minimum of what they'll accept for a credit score. For some of them it's 620, for some of them it's 640, for some of them it's like 660 or 680. So the second thing to know is that if your credit score is not where you want it to be, either you can't qualify at 620 or you just want to get up higher so you get a better rate, there are things you can start doing today in order to raise that credit score up. Now, before we get into that, let's talk a little bit about credit basics, because what you need to do to raise your credit score is going to make more sense once you understand how credit scores are actually determined. Okay? See, there are actually 30 different individual factors that go into determining your credit score, but there are 5 that are kind of the big ones that we're going to talk about today. So first of all is payment history. So how well you pay? Do you pay on time? Or do you have any late payments, either individual payments, or say you missed a payment and then you've been late every month, so that's called like a 30-day rolling late payment. And you don't want those. So payment history counts for about 35% of your score. The next thing is outstanding debt and how much debt overall you have. And that's really kind of based on how much debt you have available, like how much room you have on your credit cards, like what's your max you can spend, and how much of that max you've actually spent. And so there's a ratio, and you typically want to keep it under a certain percentage. And that counts for about 30% your outstanding debt. The next is your credit history, and that counts for around 15%. And that goes to things like how responsible you've been and how you've used your credit, good or bad, in the past. The next thing is the pursuit of new credit. That counts for around 10%. And that's things like inquiries, you go buy a car or get pre-approved on a home. And the way that you do those inquiries can have a difference, and we'll talk about that. The last of the 5 things is the type of credit that you use, and that also could be around 10%. And that goes to, like, is it a car loan, or is that a home loan? Is it a credit card? Just what are you using? And so those are the 5 big basic things that the credit score, or the credit bureaus rather, look at. Now that we know the basics of how credit scores are determined, we can talk about 9 things that you can start doing today to help raise your score on your own. Now, these 9 ways come from a free report on my website, welovehomebuyers.com. You can download the report there. So the first way is to sign up for a credit monitoring service and then check it every month. The best free one that we know of right now is Credit Karma. Now, it will show you 2 out of the 3 bureaus. And you need to know where you started so you can know when things are going up. So if you do want to see all 3 of the bureaus, you're going to need to go on to Google and Google Credit Monitoring Services. You can also get a free report once a year from all 3 bureaus, but you do need to see it more often. But if you want that free report and you haven't seen your credit for a while, you can go to annualcreditreport.com and you'll be able to see it. Step number 2 is to increase your debit to credit ratio by not closing old credit cards once you've paid them off. So suppose you have a $15,000 credit card debt. That's the total amount that you owe. And let's suppose that your total of credit available that you could spend is $30,000. In this scenario, you have a 50% credit to debit ratio. Well, let's say that you close one of your cards that has a $5,000 credit limit. Then you now, under that new scenario, would have $15,000 in credit card debt, but only $25,000 in available credit. Now your credit to debit ratio is 60% instead of 50%. So even if you're not going to use a card, it's important to keep it active so the credit to debit ratio remains low. Step number 3 is to increase the age of your credit profile. This talks about the length of time that you've actually had your credit cards and that you've been able to use credit. Credit bureaus assume that the longer you have credit available, the more responsible you are and the better risk that you become. So even if you have a credit card that has a super high interest rate, still leave those cards open because that aging helps your credit score. Now, not only does it need to be open, but it also needs to remain active. Now, what does that mean? That means that you need to use that card once every 6 months or so, and it doesn't have to be a huge purchase, but you need to use it so that the credit bureaus continue to count it toward your credit profile aging. Step number 4 is to make all of your payments on time and to try to eliminate late payments. Making all of your payments on time is a big part of determining your credit score. Now, you can also try to eliminate some of your late payments by contacting your creditors and asking them to make a good faith adjustment to take off some past late payments that would help raise your credit score. Now, if you call and you don't get a person who's very helpful, understand that most of these credit card companies are using call centers, and not even call centers that they necessarily own. So if you talk to somebody who's not very helpful, wait a while and call back later, because you're most likely going to get a new person and they might be more amenable, more willing to help. Now, be persistent. Don't be pushy, but be persistent about how good of a customer you are and how it's to their benefit to keep you as a customer by taking off some of the late payments or adjusting those late payments to help you and to help them. Step 5 is to be aware of credit limits and to evenly distribute your balances. See, you need to call all of your creditors and ask them to make sure that they report credit limits to all 3 of the major credit bureaus. Because if a credit bureau does not have the limit, their software will a lot of times report your credit as maxed out on that particular account. Now, being able to pay down credit cards is really good, but even if you can't pay a lot down on your cards, one good way to help yourself to raise your score is to redistribute the amount that you have on your cards so that it's even as possible across all the cards, or so that no one card has more than 50% of the available credit being used. Ideally, you'd be under 30% on all of your cards, but it's much better to have 50% on all your cards than to have 30% on a couple of them and 70% on others. So even them out as much as possible, and that'll help you score. Step 6 is to open a business credit card. So if you happen to be a small business owner or even a sole proprietor, you can go open a credit card under your business's name, and normally the debt on that business card won't affect your personal credit score unless you happen to make a late payment. Step number 7 is to eliminate charge-offs and liens. Now, charge-offs and liens that are less than 24 months old can do an extreme amount of damage to your credit score. So you want to pay these off first. And in fact, industry experts tell us that if you have charge-offs and you have collections, it's better to pay the charge-offs first and then pay the collections. Now, charge-offs and liens that are older than 24 months hardly affect your credit score at all. Step number 8 is to pay off your past due accounts. So on your credit report, even if you don't have a charge-off, if there's a past due amount, that past due amount will adversely affect your credit score, especially if that past due amount goes month after month after month showing past due. So it's important to do everything you can to pay off those past due amounts. Step number 9, and last but not least, is to hire a professional expert. This can get kind of complicated, and raising your credit score can seem overwhelming. And if that's the case, then reach out to the Kester Property team. We're proud to partner with experts in the Kansas City area that can give you a roadmap for how to raise your score in order to get a home loan. Thanks for joining us on our video today. Remember, if you want to download your free copy of the info that we provided today, go to welovehomebuyers.com and get your free report of how to raise your credit score. Thanks for watching, and make it a great day.